Hi there, thanks for coming to my channel. Today we're going to be talking about the difference about where to get your home loan done. You can get your loan done at either a bank, a mortgage bank, and a broker. I'm going to tell you what the difference is between all three of them, and we're going to get started right now. Banks can generally handle about 50% of the product mix out there, different types of loans out there. And mortgage bankers can do between 70 and 75%, and brokers can handle about 90%. So a bank can be constituted either a large bank like Chase, Wells Fargo, or Bank of America. And by those type of companies, what they do, those big banks, they're generally low risk loans. They're looking for higher credit scores, and they kind of have overlays. So there's the requirements done by the Fannie Mae, FHA, VA, the requirements for the guidelines. And then the banks put an overlay over the top of it, and it makes it a little bit more secure loan for them. You have regional banks that are out there, and that might be like Washington Federal or Zion Bank if you're on the West Coast here. They're generally more flexible, and they also may do specialty type of loans. Washington Federal, for example, does a lot of construction financing. And as far as where they get their funds is that banks usually get their money from the Federal Reserve. And then regional banks usually have like a line of credit with a major finance company out there, or they may get their money from their deposits. And credit unions out there, they may or may not be flexible. They may do a lot of loans. It all kind of depends on the board of directors and what their goal is to do. If they want to do a lot of loans, they can open up the door and do a lot of loans. They borrow money from their depositors, or they may get a line of credit from another major institution out there. And then what they do is they fund the loans and then sell the loans to investors through Fannie Mae, Freddie Mac, FHA, or VA. And then what will happen there is then they'll turn around and get more money back and redo the loans, do more loans. Mortgage bankers, they may be companies like Guild, Caliber, Kind Mortgage, Churchill Mortgage, Fairway Mortgage. So these are kind of a different animal. What they are is they're not banks, but really, realistically what they are is they're companies designed to do home mortgages. And that's all they do is home mortgages. Whereas banks do deposits and commercial stuff, these guys, all they do is home mortgages. And so what they do is they generally get their money from a major financial company out there. So let's say like BlackRock International, and they may get $100 million from them and on a line of credit, and they'll go do $100 million worth of loans, and they'll sell those loans and then get the profits from those loans, go back and do more loans with that money. And that's kind of how their business works. Now, benefits to them is that they're a lot more flexible than banks, and they do a lot more type of loans out there. They're quicker than banks too, generally. They may or may not retain the servicing. So what that means is basically with a bank, for example, like a large bank like Chase, they usually hold on to all the loans that they do and they service the loan. You pay Chase, and then they'll pay the investor out there. With the mortgage banks, what they'll do is they'll either have a system set up to do the servicing themselves, or what they'll do is they'll turn around and sell that to a third-party company, and then you'll work dealing with that particular company when making your payments. Now, their underwriting guidelines may be a little bit more limited than what a broker might be, but they're usually more flexible than what a bank is. And so that means the overlays may not be as severe as they would be with a bank. Now, one thing is that they may not do certain type of loans. So maybe they may not do credit scores below 620. Or they may not do a bank statement loan. So what that will mean is that they'll turn around and they might have partnership with one or two other companies out there, and they'll broker those loans out to those particular companies and get paid by those companies to send those loans that way. So they'll take your loan and send it towards that company in order to get that loan completed. And so they generally have a much more variety of type of loans out there. Now, a broker works completely different, and this is kind of the one thing that you kind of have to understand. They work as a middleman, and they're basically your personal shopper. You would go to a broker and try to give them your specific information for your particular loan that you're trying to get done. And they're going to shop your loan with a whole bunch of different companies, sometimes 15 or 20 different companies. And how they do it is they have a computer system that generally what they do is they enter your information into it, and then the computer will create a list of every company out there willing to do that particular loan that can do that type of loan, and then they'll show you what the rates are. And then it's up to the broker to go and contact those companies and find out the specifics. Do they have any specifics that may lead them so they can't do that particular loan? So then they go out and X those ones out that they can't do, and then they're left with the ones that they can do, and they present those ones to you so that you can find the right company that will work for you. So they could work with maybe one of their lists on their list is Guild, it could be Caliber, Kind, Churchill, it could be Washington Federal, it could be up to 17 or 20 different kind of companies out there. And it's up to you and the broker to work together to filter through those and find the right ones that's going to work towards your mean. So with the broker, it generally means that you're going to get faster service because you're going to be able to find the right company that can get the loan done for you in time. It's also going to generally mean the best rates out there because they're going to look for the companies that have the best rates out there at that particular time. And they're the only ones that really have a fiduciary responsibility. That means they don't work for any one of these particular companies out there. They work for you, but the way that the compliance is set up is that regardless of which company the broker goes to get you a loan, which one, they all are required contractually to pay the broker the same amount of money. So it doesn't make any difference to the broker which one they go to except to please you. So I hope you enjoyed this today. This is just kind of a quick breakdown of the different types of loan out there and different types of loan companies to go get your mortgage. Your realtor or financial consultants or something like that may give you different people to go, but I strongly suggest you talk to one of all three of these. That way you can find out the best company that may work for you so you can get the best deal on your next home loan. Thanks again for your time. I sure appreciate it, and we'll hopefully see you again on a next video. Bye for now.